Chat with Traders, episode 90.
This is your key to the minds of trading's elite performers, those who profit in relentless markets. Here on the Chat with Traders podcast, you'll hear about the skill sets and tactics that lead winning traders to win, so you can level up and become a better trader. Here's your host, Aaron Fifield.
All right, sponsors. This week's episode is sponsored by Tradeovate. Folks, commission-free futures trading has arrived. Tradeovate allows you to trade as much as you like for one flat monthly rate, which starts as low as just $39. Tradeovate has taken the traditional model of per trade commission and tossed it out the door. Also included in the monthly membership rate is Tradeovate's proprietary cloud-based trading platform at no extra cost. To learn more, visit tradeovate.com/traders and sign up for a free 2-week demo. Now that's spelled TRADOVATE. Tradeovate.com/traders. What's happening, guys? Here we go for another episode. This time I'm joined by Michael Halsmore, who runs QuantStart.com. This is a site which is very popular, very well known amongst algo traders. Now, just for a little background, prior to trading, Michael studied computational fluid dynamics and was the co-founder of a tech startup before getting involved in a small equity fund as a quant developer, where his key role there was cleansing data. Now, I know that may not sound overly sexy, but as you'll soon hear, we actually get into the importance of having clean, good quality data, especially when you're running an automated strategy. Now, today, independently, Michael trades his own short-term algorithmic strategies. He consults to hedge funds on machine learning and quant infrastructure, and also has a keen interest in space exploration. We discussed many interesting topics, some of which include thinking about risk management from a portfolio level, trading multiple automated strategies, the role of common sense in parameter optimization, where to start if you're interested in programming and where to turn to if you get stuck, plus a whole lot more as well. Now, I will say I was really stoked to bring Michael on. Like he'll tell you, I've been bugging him for quite some time to try and make this happen. So I do hope you'll enjoy this episode. Anyway, guys, let's get right into it. Here it is, my interview with Michael Halsmore.
Why not? We may as well get started. Yeah, sounds good to me.
So, I mean, one of the first things I wanted to ask you about, as someone who lives in the UK there, what's your take on the whole Brexit situation?
Well, okay, so I'll get political for a second. So I'm not particularly keen to that we've left. I would have preferred to have stayed in. I voted to stay in. I did most of my sort of professional development, if you like, in London, and many of my colleagues, not only at university and in the workplace and through various roles I've had, have all been EU nationals for the most part, and so it's very natural for me to think of the UK as a kind of a sort of outward-looking European country, but obviously 52% didn't agree, and we things went a bit south, certainly in the forex market for us. I hope. I mean, I don't know if you've heard just today, but we've got a new Prime Minister now, or will have very shortly, in Theresa May, and maybe this will calm the market somewhat a little bit. But my personal view is the damage has sort of been done, really, and that banks are going to make good on their promises and move out to Dublin, Frankfurt, Amsterdam, lots of centres where they can get access to a much larger pool of hiring talent, really. So that's my take on it.
So, I mean, what do you anticipate will change, like, as a result of this for someone like yourself who's living in the UK? Like, what do you anticipate might change moving forward?
Okay, so I think, firstly, if you're an EU national, your status is up in the air right now. There's, nobody knows really what's going to happen in terms of when we're going to kick off this Article 50 process of, leaving the Union. I'd be worried, frankly, especially if you're studying, because a lot of quants do come from an academic background, principally postgraduate research or sort of more technical undergraduate research, and they might now be thinking, well, should I stay in the UK? And I've got a lot of anecdotal stories, about students who are going back to their home countries in the EU now rather than staying in London. So it's going to reduce London's sort of hiring pool quite significantly. And I think the banks will just catch on to that. And because it's so easy for the banks to sort of move operations these days, everything's computerized and automated. I think we'll see a lot of shifting out, banks to other parts. And so it just makes it that bit harder for even the UK students to find work, because now they have to really, if you like, compete with the continent, whereas before they didn't have to necessarily compete; they had access to it all. So it just makes it that bit trickier, and that just makes things a little bit more expensive and difficult.
Okay. So, what was I going to say? So, now that we've got the heavy stuff out of the way, straight into it. Before we get into the actual trading part of your background, I believe that you were involved in a couple startups before you even came to finance. Can you tell us a little bit about some of the startups you were involved with?
Yeah, that's right, actually. So to sort of frame this in context a bit, when I was doing postgraduate study, I was very interested in fluid dynamics. Okay, so the equations for fluid dynamics are very, very similar to those that are used in options pricing. So the whole Black-Scholes model and all the which was really popular at the time, because in sort of 2005, 2006, because everyone was trying to sell mortgage-backed securities, and so they needed a way to price these financial assets. And so it was very, very it was quite straightforward at the time to go and work in quant finance if you had any sort of background in sort of statistics or engineering, fluid mechanics, that sort of thing. So I'd also, over a long period of time, sort of taught myself web development and programming, and then doing more postgraduate research, learn more sophisticated programming, if you like. And what I was thinking at the time is I was either going to go into quant finance or go into technology startups, which nowadays everyone and their dog wants to build an app, but at the time it was a bit more of a cottage industry. And so I started a startup straight out of postgraduate research with a friend of mine. And it was actually a social network, sort of a bit like Twitter, but it was for building, for posting jokes. So we did quite well for a while, and we did get some funding. Ultimately, it didn't work out after a couple of years. We didn't really find the right business model, and so we parted ways. But straight after that, actually, one of the investors who invested in this actually put me in touch with a friend of his who was just starting a sort of small equities fund, and they needed a quant developer, if you like. So this is, for those who don't know, a quant developer is somebody who codes up in programming languages all of these sort of statistical algorithms, generally derived from the sort of what would be known as the quant trader or the quant researcher. So it's the sort of other half, if you like, of quant trading. And so this role, which I was in for about 2 years, was sort of really where I cut my teeth, if you like, in learning the ropes in sort of institutional mindset of how these sort of funds actually go about their trading. So it was a very, very good kind of baptism of fire, if you like, good education in quant finance.
Okay, so that was really your first introduction to trading. Was through.
Yeah, that was so up until then I'd largely been sort of theoretical, if you like, much more interested in the sort of mathematics of it. But this was my first proper live trading exercise at the coalface. So it was definitely really eye-opening, I think, in terms of what happens when theory meets practice, and then seeing what really happens in the real world, not in the textbook, if you like. And I think it formed a lot of my early sort of key takeaways, lessons, because we were there's a lot of volatility in that period. I think around 2011 there was some pretty chunky volatility. I remember. I think that was the era of the Japanese tsunami. I think that was then, and so there was a lot of turbulence going on in the markets at the time. So it was very interesting to sort of work through that.
Okay, so tell us a little bit more about what you were actually doing. In your role as a quant developer with the fund, like what were you doing on sort of a day-to-day basis? Like what would that look like?
Okay, so the prime task really of a quant developer is to build what they would call the trading infrastructure. So these are all the kind of modules or components that form an entire end-to-end automated trading system. So a lot of that actually is actually to do with data, obtaining data and cleaning it. So there's a huge amount of work, probably vastly underestimated actually, it goes into getting hold of good financial data and then cleaning it to make it robust enough to be used in proper statistical analysis. So a lot of my sort of early role was sort of setting up a database and making sure that all of the financial data from all these different vendors was clean. And by clean, I mean was free of sort of what they would call spikes. So this would be, the price suddenly becoming 10 times the amount just because of a typo, and then reverting right back to the normal level again. Or just making sure that corporate actions such as dividends, stock splits were all accounted for. Obviously, if you look at a raw price feed and it drops by 50%, you might think the world is coming to an end, but in actual fact, it's just done a sort of stock split. And we had to make sure that all these were married up because these signals were going straight into a live, continuous algorithmic system. And so we didn't want any sort of bad data going in that would obviously trigger a trade that was really nonsensical. So a lot of work goes into this data cleansing. In fact, there's a sort of small anecdote. The quant trader that I worked with at his former role, he told me that they had about 4 to 5 PhDs. Their entire day job was just obtaining data and cleaning it for the rest of the team in a larger fund. So there's a lot of investment going into data cleansing, and it's not really something that's very often discussed in the kind of quant blogosphere, if you like, because it's not really a sexy topic. Nobody really wants to talk about, running through reams of terabytes of data to clean it. But it's one of those things that's absolutely necessary in a kind of institutional setting. So that was sort of the first part, really, the data cleansing. And then the rest of it really involved sort of being very careful and testing each of these components or modules that did a particular task. So the risk management module, the sort of portfolio and order management module, the execution module. So all of these were sort of isolated components that talk to each other, and they all needed to be tested. And a lot of that testing involved trying to throw bad data at them in order to get them to break in ways that you don't expect. So a lot of it is really just coming up with these sort of quirky ways that these systems might fail in the real setting, and then just absolutely making sure as much as you can that they are going to be as robust as possible. Because once you've deployed it live, if bad data gets in there, it can cause all sorts of havoc, as you can imagine. There's plenty of stories around of things that have gone wrong in algorithmic trading. So that's roughly what I was doing, just making sure these systems were sort of impervious to harm, if you like.
Okay, very good. That's really interesting. I want to ask you a little bit more about data a little bit later too. So I've made a note of that. Were you ever sort of hands-on? Did you have any input on how the actual strategies traded? Were you involved in that aspect of the fund?
Well, we had quite an alternative means of actually obtaining strategy. So what we did is we were sort of scouring the internet for lots of alternative data sources. Not your we did use traditional pricing data, but we also used a lot of documentation and sort of text data, natural language data, and used that essentially to augment our signals. So we would take a lot of blogs, a lot of more structured kind of data, and then try and sort of mix it all into a big pot, if you like, that would produce us lots of consistent and agreeing signals, at which point we would trade based on that, rather than relying too much on any one sort of indicator or any one particular mechanism. So we tried to have all the stars in alignment, if you like, before we took some trades. But I was, so the way the actual sort of trading mechanism worked is we would have sort of weekly meetings where the quant trader would present new strategies that he had determined and come across, and then we would try and break them down into their sort of constituent components and then try and fit them into our system. So I didn't have any direct input into the sort of development of the trading strategies themselves, but I was pretty intimately involved in their implementation, if you like. So the quant trader, the quant researcher's goal was really to find new ways of, I guess you'd call it generating alpha, if you like, finding signal. And my goal was to try and slot that mechanism into the system that we already had in such a way that it was risk managed and the position sizing would not sort of go outside our risk bounds, if you like.
And what markets, I'm just curious, what markets were you mostly trading there at the fund?
So initially, probably like everyone else, we were trading very liquid, kind of large cap US equities. The brokerage that we were using was very cheap to trade those. And I think later on, we actually also expanded into what I guess would be a sort of fund of fund mentality, which is where we found other funds and we allocated a certain amount of our portfolio to these other funds, which were doing so a lot of them were what we called CTAs, commodity trading advisors, so kind of quant trend following funds. And so we had our own internal strategies, but we also had part of our portfolio allocated to external managers. And so that made for quite an interesting portfolio construction and risk management approach. So probably quite different from a lot of quant funds, which completely internalize everything. But we were trying to go for a sort of diversified approach, not our own strategies as well as others.
Okay, cool. So why did you leave the fund? I think you mentioned you were there for around about 2 years. What led to the decision to go out and trade independently?
So a couple of things. I think we had some difficulty trying to secure the next institutional round of funding. So we had what I guess would be called a sort of friends and family round right at the start, which by technology startup standards was quite high, but for quant hedge fund startups was pretty good. It was average, but we needed to sort of go to the next level and really attract institutional investment. And it was tricky. It was a tricky environment to raise money in at the time, and ultimately we didn't manage to do so. So we sort of disbanded. And then I continued doing a lot of software development at the time, which is what I was really, I was really a programmer, if you like, quant programmer. And so I ended up doing a lot of consulting in machine learning and data science, which was, again, at the time, only just really becoming a thing, if you like. And then all the while, I was sort of building QuantStart. And eventually got to the point where QuantStart was becoming a good fraction of my sort of income, and now I sort of only periodically do consulting for sort of smaller funds in the kind of machine learning and software development quant infrastructure. So I'd sort of do a mix now. So that's how I ended up where I am.
No, that's really cool. And are they funds that are local to you there in London, or are they international? Like who?
Yeah, so I've mainly been helping a company that's based out in Zurich, but they have a UK office. But I've also been helping a local UK fund periodically on a sort of advice basis to help them get their infrastructure up and running. Because you'll find that a lot of sort of early stage quant funds are run by ex portfolio managers. Now they're used to having a lot of IT infrastructure behind them. They can pick up the phone and just ring the IT department or the quant dev department when something goes wrong. But once they branch out onto their own, they are usually, they're very, very good on the strategy development, very, very good on the statistics and portfolio management, but they lack kind of infrastructure deployment skills, if you like. So this is how to take their strategy and put it into the cloud or put it against a brokerage. And that's where there's a lot of scope for bringing in a kind of quant developer to help them get off to the right start, rather than building a kind of house of cards of software that doesn't really isn't robust enough. I mean, obviously, while this may not be a problem in retail trading, it is a big problem in institutional, that they need to be very compliant. There's a huge amount of compliance and regulation that needs to be followed, and it's one of the big headaches of the industry is the amount of sort of time that's spent just taking care of compliance. And this is something that you don't really have to worry about too much in sort of normal retail trading settings, because you're trading on your own account. But when you're trading others' money, it's a very different story. So a lot of building these systems is about making sure they're compliant, and the regulators and the compliance is all happy.
Let's talk a little more about how you're actually trading today. Can you share some insight to the types of strategies that you yourself are developing and trading to this day?
Okay, so my sort of focus with trading tends to be probably I'll sort of say that I tend to think much more on the portfolio level about trading rather than the individual strategy level. So I will, the sort of main goal, if you like, in quant trading is well, in fact, trading in general probably is you're trying to maximize your expected returns, if you like, your expected value, but you're also trying to minimize your risk, your sort of long-term risk. So with those two constraints, I tend to see that at the portfolio level. And so what I would tend to do is put in strategies into a kind of already existing portfolio if I believe they will either reduce the risk of the portfolio going forward or increase its expected returns without bringing in too much new risk. Okay, and that is generally how institutions think. You're basically always worried about these two factors. It's not, when it's your own, personal account, it's not so much of a problem, risk management, because if you've got the stomach for it and you understand that, the strategies you're trading are going to have chunky drawdowns at some point, you just have to sit through them when you come to see them in live trading. So risk management is different for retail, but in institutional settings, it's much more stringent. There's a lot of things you can't do, and you've got to be conscious of the fact that you're managing others' money. So a lot of the consulting I do is really of the latter type. So the sort of trading I'm involved with at the moment is mainly making sure that a lot of the stuff is risk minimized, which maybe it might sound a bit counterintuitive. That a lot of people concentrate on the strategy and what strategies are you running and how's your alpha generated. But I would say a big piece and a vastly sort of ignored piece in the kind of retail sort of quant sphere is risk management, because it's one of the ways that you can actually make more money, in my opinion. To have a very good, solid risk management system will actually make you more money over the long run, because you're not losing as much money. I think people forget that it's not just about making money, it's about preserving the money you already have. So a lot of what I do is I spend time looking at risk management. My personal view on kind of the strategies, as you say, is that they're quite easy to find. Trading strategies are really abundant in the literature. They're all over the internet. There's plenty of blogs and forums, podcasts, obviously. There's also hundreds of research papers that get published on every day on new trading strategies. So I don't think that it's difficult if there's such to find them. I think it's very hard to test them and make sure that they are doing what they say on the tin. But finding them is not really difficult. So I tend to stick really with some pretty simple stuff. I tend to stick with the sort of trend following and sort of mean reversion type strategies. But bear in mind that I tend to think on a much more of a sort of portfolio level. So I'll have a few strategies running at once, rather than concentrating on the sort of world's greatest trend following strategy, or the world's greatest mean reversion, if you like. So really diversification across lots of different strategies. That's my approach.
Okay, so when you highlighted risk management there as being, one of the most important factors in your eyes, are you looking at risk management from a portfolio level or on an individual sort of strategy level?
Generally on the portfolio level. So obviously, two strategies can produce opposing trades, and if they're in your portfolio at the same time, you have to decide what you do. Do you not trade? If somebody wants to go long an instrument, and another one wants to go short an instrument by different fractions, you have to net that out somehow. So I tend to think of this not on the strategy level, but on the portfolio level. So I mean the obvious tools are things like the Sharpe ratio and your maximum drawdown. They're the sort of bread and butter of portfolio management. But the other sort of risk management techniques I tend to think about, will include, at least at the institutional level in consulting, I'll be thinking a lot about, average daily volume limits. So if we're trading on, more niche markets, are we likely to be hitting anywhere near a good fraction of, the day's average volume? Because if you are, then you're having a substantial impact on the market itself, at which point all of your prior sort of analysis, your back testing, if you like, is essentially rendered useless, because you're interacting with your own market at that stage, in a way that's heavily modifying it. So things like, making sure we're not too sector dependent, and that, the risks that we don't want to take, for instance, are hedged out. If we're running a strategy that's supposed to be neutral, we don't really want to be exposed, say, for instance, to US equity market broadly. So you'll hedge that out, and therefore you're only, as much as you can, you're trying to concentrate on the risks of your actual portfolio, not of the wider risks to the rest of the world, if you like. You don't want to be subject to sort of huge market fluctuations if that's not what you're trying to trade.
Okay, and are all these considerations built into your risk management module, or are these things that you're monitoring with some discretion?
So I tend to automate everything as much as I can. And the reason for that is because I think it's very easy psychologically. I think they call this recency bias, which is very easy to sort of look at, the last week or today's, activity as something that is very new. Oh, we've never seen this before, it's never happened before. But in actual fact, if you step back through time, there are plenty of cases where sort of terrible things have happened in the markets. It's just that people forget. And so as a quant, you're constantly trying to eliminate all of these sort of psychological biases, and that's kind of baked in to your risk management, and you have to have quite a strong element of trust that what's happened in the past will probably happen again in the future in terms of bad things happening, and that it's not just different today. So it means it's the main reason for this is that it's measurable and it's objective. You're not going on hunches, you're not going on gut feels. You're sort of eliminating all of your own biases as much as possible. And then it's only down to the raw maths and statistics of it, if you like. If that makes sense.
Absolutely. No, 100% makes sense. I mean, that's one of the things that attracts me, on a personal level to quantitative trading as well.
Well, I would say as a flip side that people do have a tendency to get very myopic as well about, blindly following the numbers just because the numbers say things. I mean, statistics is not perfect art by any means. It's a tool to help you make decisions fundamentally. And sometimes, if you've got incomplete data, or you don't have the entire picture, then statistics won't magically tell you that things are the right way to do it. I think there is a sort of discretion that does come into it, but the discretion happens at the research phase before you implement the trading strategy, I think, if you like. So that's where the discretion comes in.
Okay, we'll get back to the episode in just one moment, guys. Right now, let's give a shout out to Chat with Traders sponsor and supporter, Tradeovate. Tradeovate are really shaking up and disrupting the landscape of futures trading. They are the first futures brokerage to offer commission-free trading and proprietary technology as a single all-you-can-consume monthly subscription. Tradeovate sees traditional per-trade commission as an old way of doing business. So they combined their brokerage and proprietary trading technology into a single service which allows customers to trade unlimited contracts commission-free and only pay a flat subscription fee at the beginning of each month. So it's really easy to see how the exclusive savings quickly do stack up, especially when plans begin as low as just $39 and include full usage of their cloud-based platform at no additional cost. Tradeovate also make futures trading very accessible by offering low day trading margins and low account minimums. Now, there are certainly some benefits to this, but please remember what you have learned about risk management also. To get more info about Tradeovate's platform, pricing, support, free 2-week trial, and pretty much everything else, visit tradeovate.com/traders. Tradeovate is spelt TRADOVATE. Tradeovate.com/traders. You described a lot of the strategies that make up your portfolio as trend following or mean reversion, but just the trend following, I mean, often when we hear the term trend following, we sort of think long-term trades that could go for 3 to 12 months maybe, or sometimes longer. Are these the types of strategies you're talking about, or are you talking about sort of intraday trends that you're following?
So I tend to trade on a sort of more shorter time scale generally, and the consulting I do tends to be with funds that are also thinking on a more shorter time scale. Now, the reason for that is because when you're trading over longer time scales, while you do have, while there is probably more, I guess, signal per trade, if you like, that it's harder to predict the future much further out. So if you are taking like a big global macro sort of bet, then it's likely it can pay off. But the problem is that it's very difficult to draw any conclusions from one or two or 3 or 4 long-term trades in a statistical sense. You can't use traditional statistical theory to say easily whether those trades happened by chance or whether they were, part of your skills, if you like. So the quant traders like shorter term trading principally because it gives them more trades to analyze. Now, it is probably harder per trade to sort of get some signal out of there because there's a lot of sort of short term fluctuation that really is not, I don't know, so it's not really underlying signal. It's just literally short-term wiggles. But the thing is, you have access to a lot more trades, and therefore you can start applying statistical tools that will say, did these series of trades that I placed that were profitable come about simply because I flipped a coin the right way? Or is it because there is some underlying profitability there that I've captured? So I tend to prefer working on the shorter time scale for that reason. Now, the other problem with working at the shorter timescales is that you're competing with a lot of funds that have a huge technology budget to play with, and vast teams of quants that can go ahead. So you have to really look for sort of more specific areas that are just unattractive for these funds to play in, because otherwise you're not likely to have a strong edge against them. Because if you think about it, they're doing this all day, every day, with tens or hundreds of people. So they will likely know a lot of the edge. So I tend to look for things where there's a lot of capacity constraints. That if they've got huge amounts of money to deploy, a large assets under management AUM, then they're not going to be interested too much in low capacity strategies, because it's not worth their time to put small amounts of money against these smaller niche markets, because they need to deploy a lot of capital, and therefore they need more liquid markets, if you like. If that makes sense.
Absolutely, yeah. That was a brilliant answer, Mike. So generally speaking, what's the logic of your strategies for buying and selling? Like, are they based upon traditional technical analysis? Are they based upon order flow? Are you trading pairs, or what are some of the factors that tell your strategies when to buy and sell?
Okay, so for mean reversion, I guess we can have a look at that. I tend to use a lot of time series analysis. So there's a huge wealth of statistical tools that you can bring to bear from kind of econometrics time series analysis, such as cointegration, and which is is quite a well known mechanism. So that essentially states that there is a sort of fundamental, I guess what you'd call physical relationship between two assets or two or more assets, and just by virtue of them of how they're structured. So the sort of canonical, perhaps sort of slightly silly example is when you have two share classes on the same asset. Okay, they are both going to be tracking the underlying movement. So I think I wrote recently about Royal Dutch Shell, the big oil major. There's two share classes there, and they will trade slightly differently themselves, but there's no sort of getting around the fact that they both have to track the underlying performance of the company in the long term. So they share a structural relationship. Now it's quite hard to trade something like that because the structural relationship is very tight. But in other situations, and a sort of good sort of fertile field for these sort of things is to be found when looking at things where you have like physical commodities as well. So I think so. A lot of assets that track these physical commodities will have structural dependence, which can be detected, if you like, via these kind of cointegration and stationarity techniques. And once you've detected this over a lot of assets, which gives you the ability to diversify, you can then use pretty straightforward actual trading signals. They're really not really much more complicated than if the signals diverge dramatically, in a traditional pairs sense, then you buy in, and if they converge, you sell out again. So the sort of secret sauce, if you like, to this is in optimizing the parameters as to when you buy and when you sell. As everyone's well aware, the devil's in the details, and so I would spend a lot of time perhaps using simple trading strategies, but spend a lot of time actually optimizing the parameters of those strategies in order to not only sort of maximize the returns, but also minimize the risk. I mean, there's a lot of risk in doing mean reversion. It's if you get it wrong, you can get it very wrong. So you have to be very careful and quite sure when you're placing a trade. So that's roughly the process I do. So I wouldn't say there's any major. I don't use any really incredibly special sort of mean reversion techniques. I just tend to be very cautious about my parameter optimization, making sure that what I do have is very is pretty robust, if you like.
Yeah. Okay, so just a couple things based on what you said there. Time series analysis, what's that actually referring to? Could you just maybe explain that? Give us a brief overview of what exactly is time series analysis.
Yeah, so the basic idea is that you've got a set of points of data, each of which has a sort of day or time point associated with it. And usually the sort of obvious example is pricing data. So what you might want to look at with one of these time series is you might take Google or Apple stock price and you'll say, is this time series actually increasing? So is there actually an underlying trend there? Or is it just a series of random steps up or down? Okay, because if it's the latter, then it has no predictive power whatsoever. They call it a random walk. So even though something may look like it's gone up over time, there's actually no ability, if you like, to trade it. There's no predictive power in its past data to give you new data. So what time series analysis is really all about is taking a kind of historical series and saying, do the previous days or previous weeks of data, do they tell me anything about what the likelihood of the next day or the next week's data are going to be? Because if they don't, then there's absolutely no point in using it. But generally you find that there is a little bit of predictive capability. It's not much, but generally because markets are very efficient, but certainly once you start looking at more structured niche markets, you will certainly see that the technical term for this is autocorrelation. It basically means that you can predict partially tomorrow's price based on previous day's prices. And if you have what they would call a sort of positive autocorrelation, then you will hope that you could use that to exploit what is essentially an inefficiency and then make a trade based on it. So time series analysis is all about understanding the kind of autocorrelation structure of past data so that you can use it to predict the future structure, if that makes sense.
Yeah, and I know you've written about this extensively on QuantStart, so what we might do is dig up a couple articles and we'll link to those in the show notes. How does that sound?
Yeah, it sounds great. So, I mean, there's obviously, the way to think of this really is that it's all about modeling. So you have to, you're coming up with a model, which is essentially an idealization of reality that has, is either can be quite simplistic or it can be very complicated. And, the simpler it is, the more easy it is to interpret and understand, but the less it will match the real world. Whereas the more complicated it is, it's much harder to understand and much harder to interpret, but you would hope that given enough data, it will match the real world a lot better. So a lot of time series analysis is really about understanding these different models and accounting for different events that happen in financial markets. So shocks to the system, like Brexit, I guess, could be considered a bit of a shock. The market was fully expecting a Remain vote. In fact, it was pretty much a dead certainty, I think, before the results came in. And so this would be considered like a structural shock to the market. And so time series analysis has to take in not only the kind of day-to-day fluctuations, but also account for these sort of left field structural shocks if they're to be useful. Because otherwise, if they don't take them into account and they are happening in real life, then your model is not really matching reality in any real sense. So it won't be profitable to trade it.
That was a really good answer. The second thing I wanted to ask you about, based off what you said just before, was optimizing parameters. Like, how do you approach this? What's your approach to optimizing parameters?
Okay, well, I'll firstly say that it is probably one of the hardest aspects of quant finance or quant trading in general is parameter optimization. I mean, it's not only difficult in a theoretical sense, but it's also very practically difficult. I mean, it's quite easy to convince oneself in backtesting that you've found the world's greatest strategy simply by varying your parameters. So the classic example is the like the moving average cross strategy. You might adjust the two moving average look back windows, and then you might find that some particular obscure combination gives you a great result on that particular data set you've looked at, but as soon as you put it into practice, it fails completely. So that's what's classically known as overfitting. Which is where you've constructed your model so closely to the historical data that it doesn't account for future changes, if you like, very easily, and so it falls apart. And this is really common. It's probably one of the biggest pitfalls in sort of quant trading when people get started. So there's a couple of ways of dealing with it. I guess there's no sort of way of completely eliminating it, but there are ways of reducing its impact, if you like. So the classic statistical mechanism is known as cross validation. So the basic idea with cross-validation is that you can sort of randomly partition your historical data or your previous data into batches, and then you try, using your model, if you like, on all of these different batches, and then you take a kind of average of what they produce, so that it's almost like you're giving it 10 separate universes to have a go at, rather than one big universe, if you like. And that statistically is a lot more valid, and it makes it more likely that it will perform better as it goes forward. So that's the key sort of technique in statistics and machine learning to deal with this. There's a few different variants of it, but it's all related to this rather sort of esoteric statistical concept known as the bias variance trade-off. And in trading, probably the best way to deal with parameter overfitting is with this cross-validation mechanism. So thankfully these days it's quite easy to do. A lot of the quant tools, especially in programming tools that I use, they have kind of built-in systems for just performing cross-validation, or CV, as a lot of people call it. So it's much easier nowadays to actually come out with a much more robust backtest than it was, say, even 10 years ago, when you had to program all this stuff yourself over and over again. So that's the key way I deal with parameter fitting. But I also, you also have to actually step back and look at what you're actually doing. I mean, if you look at a sort of moving average cross, for instance, and you're just randomly adjusting the look back windows until you get, a nice result, you've really got to say to yourself, why is a sort of 50 period or 206 period or 138 period moving average good? What's special about 138 compared to 139 or 150 or 160? So you also have to have a kind of physical intuition and say, does this really make sense? Is there really something that is happening on a 138-day scale that is not happening at 136 or 135? So, a lot of it does come down to common sense as well, if that makes sense.
Yeah, totally. So you dropped the word machine learning there. I'd love to ask you a bit more about that.
Okay.
That cross-validation, is that a machine learning, what's the right word, tactic? I mean, is that...
Yeah, it's a method that is sort of comes over from a field known as statistical learning. So, I mean, in quant finance, you have, or sort of theoretical statistics, if you like, you have two camps. You've really got the sort of traditional statisticians, and then you have the kind of computer scientists, and machine learning is like a marriage of these kind of two worlds. One of them is very, very good at data analysis and interpreting data, and it's used extensively in things like clinical trials, all the kind of bread and butter statistics stuff you read about in the newspaper. And then the other is all about, the computer science is all about taking huge amounts of data and sort of trying to find patterns within it, in a very different way. And so statistical machine learning, if you like, is kind of a marriage of those two worlds. And cross-validation is a sort of technique that was born out of that marriage, I think. So it's a nice kind of sort of heuristic process for, doing parameter optimization. That is pretty objective. You can see the results of it. It's not hand wavy. You're not just saying, "Oh, this looks good." It is a very kind of objective approach.
Sure. And do you use machine learning in any other aspects of your trading? So there we kind of talked about, optimizing parameters and the back testing process. Do you use it in any other areas of your trading as well?
Yeah, definitely. I mean, it's very widely used. I think the canonical example that people have of machine learning is, what is tomorrow's price based on some model of all the past prices. Okay, a bit similar to time series analysis, but with different models. So that does occur, certainly, and I've talked about it a lot on the site. But in institutional settings, machine learning is generally used for things which you might not expect. So you might be looking for. So let's take, for example, people who run ETFs that track stock indices. So something like the SPDR ETF that tracks the US S&P 500. So they have a kind of physical mandate to buy and sell shares in the S&P constituents as and when they get knocked out. Okay, so that is a sort of structural thing that's happening in the market, and they will obviously do their best to try and minimize the impact of this sort of necessary trading that they have to do in large block sizes. You can imagine some of the big funds that have to do this and sell in and out. So they try their best to kind of mask these big orders so that the hedge funds don't sort of look at them and go, aha, we know what you're doing there. We can sort of trade based on the fact we know that you're going to be dumping a large block of shares in the market. So machine learning is a good way of finding these patterns of how I guess there's essentially execution patterns of how these big funds are dumping or buying these shares on the market. So what might not be structurally evident to the sort of naked eye will, over a long time period, be very structurally evident to a kind of machine learning tool, because they can learn from these sort of huge amounts of data that the S&P relies on. So you might also find it used in situations where you're trying to predict spreads of a particular or stock or trading asset that you're interested in, because if you can, while you may obviously want to try and predict direction, it's also very useful to be able to predict spreads, because if you know in the next time period or the next month or whatever that spreads are going to be slightly higher, you may want to downvote or downweigh the possibility of making a trade in that period because it will be more expensive. And again, this is a kind of rather than increasing returns, this is sort of decreasing costs, if you like. So that's another area where it's used. So it's used a lot in these kind of non-traditional ways, and by non-traditional I mean predicting tomorrow's price from kind of historical prices. But probably the final or an additional use for it is in much more non-traditional data sources. So there's a huge amount of social data, videos, images, tweets, satellite data, lots of what would typically be called non-numeric data, non-pricing data. And machine learning techniques, they absolutely excel at kind of finding patterns within these. So you can think of a simple example where you might have a hedge fund that's paid for a lot of real-time satellite data over crop fields in certain parts of the world, and by aggregating all of these sort of crop images, they can ascertain whether there's going to be a good crop yield or bad yield in the future. And so that is a sort of perfect example of where machine learning techniques absolutely excel, because they'll be using that to sort of say, this field is not as healthy as we thought, this field's a bit more healthier than we thought. And so it's very non-traditional. You're not using pricing data at all. You're really just using physical image data. And that's where machine learning can really excel, I'd say.
Yeah, I was going to ask you about that because I saw you'd written about it on QuantStart, and it blew my mind. Like, I had no idea this sort of thing went on. That there was satellite imagery. Like, who would have thought that could have been used to generate trading ideas? Like, that's so wild.
It is wild. I mean, the thing is, hedge funds are so competitive nowadays. There's so many of them, and it's a lot easier to start a quant hedge fund, than it was. Still very expensive and tricky, but it's less tricky. And as such, if you're pitching to an investor, you've really got to sort of say, what is my secret sauce? What are you doing differently from all the other trend following or mean reverting funds out there? And so in this sort of desperate quest for alpha, a lot of these funds are turning to these kinds of sources of data. So I think I mentioned probably the post you're referring to is looking at some of the car parks of some of the big retailers, via satellite imagery and seeing how many cars are parked there, because that will give you an indication as to what their earnings are going to be like in the next quarter. Which again, it does blow your mind a bit to think that people are doing this, but it happens in all sorts of different ways. There's a lot of websites that will track aircraft and ships around the world. And so a lot of hedge funds will use this kind of maritime traffic data to see, whether oil's being stored or, and therefore what the kind of supply demand imbalance is Obviously, these are all models. They're not. There's only so much you can do. You're always seeing a piece of the puzzle, but even that is sufficient, if you like, to have an edge, a very direct, kind of clear physical edge over the rest of the market. So that's what a lot of these hedge funds tend to specialize in. And so you can imagine then the importance of obtaining, cleaning, and sort of analyzing this data becomes a sort of first-class citizen, if you like.
Yeah, no, that's really incredible. So just leading on from machine learning a little bit to artificial intelligence, I mean, do you think artificial intelligence has a place in the future of trading?
I mean, firstly, AI is quite a broad term, but I think probably what we're talking about here is something called, at least there's one specific area of AI, which is probably reinforcement learning, which has become very famous recently because of a firm called DeepMind, which is actually based here in London. They built some AI tools to sort of defeat that sort of ancient game of Go, which is a very complex strategy game. I know they are doing a lot of work about trying to apply that to any National Health Service data here in the UK. So all of our hospital records, anonymized hospital records. So in terms of trading, they use a process known as reinforcement learning for this sort of stuff. And the basic idea with reinforcement learning is that it's the sort of third pillar of machine learning. And the idea is that you have what they would call an agent who is essentially pretty dumb and sort of wanders around in whatever kind of space they have, and then tries to do stuff, and they get rewarded or punished depending on what actually occurs. So in trading, this would obviously be, you'd have a sort of stupid trading bot that would periodically buy and sell randomly, and then it would be rewarded, if you like, by making money and penalized by losing money. So by doing that over and over and over again in a kind of simulated way, the sort of reinforcement learner would eventually and hopefully learn through kind of structure of what's going on in the trading data, how to get better. So I'm pretty confident, although I'm not 100% sure, but I'm pretty confident that there must be a lot of secretive work going into this area in some of the big quant funds. You can sort of see, because one of the great ways to tell what quant funds are really up to is to look at who they're hiring and what type of people they're hiring. So there's a few sort of quant job sites around, and if you see what sort of skills they're currently looking for, it does give you a bit of an indication as to what kind of research areas they're thinking of looking at. So I've seen a few reinforcement learning demands, so I'm assuming it is going on. But as you know, it's a very secretive world, and people aren't generally willing to share too much. So
yeah, very interesting indeed. One more subject I'd like to dive into with you is just programming in general. So, a question, you probably get it all the time, it's a very common question, is what language should someone use for algorithmic trading? Like, how do you address this? Because I know there's not like one single one-size-fits-all answer. So, I mean, what would you suggest?
Okay, so there's kind of two answers. There's the short one and the long one, and I'll give both. So the short one is that I tend to use Python, which is becoming really popular these days, even in institutional settings, principally because it's really easy to learn, even for complete beginners who've never done any programming. And it's kind of fast enough for doing things. But the main reason is that it has a lot of what they would call libraries. Okay, so these are sort of modules that other people have written to do lots of different things. So there's hardly any need usually to implement lots of sort of simpler stuff yourself. You can just find somebody else who's already done it, and usually they've given it away for free. Then you can just sort of import it into your projects. So that's the short answer is I would go with Python for those reasons. The longer answer is really, it's sort of like asking what's the best way to drive from the south of Australia to the north of Australia. I mean, that would depend whether you're wanting to get there really fast, in which case you take a Ferrari, or whether you want to carry 10 tons of food with you, then you take a big HGV truck. So the question really needs to be framed in sort of what do you want from your algo trading. I mean, if you're doing high frequency trading, sub-second trading where you need really rapid execution speed, then you would use something like C or C++, or even some of the high frequency trading firms, they write their own custom chips. They make their own circuit boards a lot of the time. So they're really, they really optimize to the nth degree for speed. But if you're doing longer term trading, Python is pretty sufficient. I mean, there are areas where it doesn't do so well. It's not so good at really deep statistical analysis. I mean, it's not designed for that. It is, it's a general purpose programming language that, a lot of websites are written in it, for instance, and, scientific applications. It's not a statistical tool like R, which is, was designed from the ground up to be a kind of statistical environment. R is also very heavily used in hedge funds for research, but equally R doesn't have Python's ability to sort of talk to everything very easily, and it's not very good for actual algorithmic trading infrastructure. It's great for doing the research, but it's not so good for infrastructure. So in some sense, you use the right tool for the job. I mean, Python is probably the sort of jack of all trades, master of some. So it is a kind of good sort of one size fits all language. I use it for all my own stuff. I use C++ occasionally for things I really need to be fast, but I almost always use Python, and I have done even in institutional settings. A lot of my sort of colleagues, they also all use Python. It's great for machine learning. But it really comes down to what it is you're doing. So the short answer is Python for pretty much everything except HFT, in which case you should use C or C++, really.
Okay. So do you have any tips for how to actually learn how to program? Like for someone who's currently, a non-programmer, what would be the most efficient way for them to learn a new language and make sure that they're really learning the right things about that language?
Yeah, definitely. So these days, it's really easy, no matter what platform you're using, so Mac, Linux, Windows, whatever, to actually install Python. On Linux, it sort of comes with it anyway. But on Windows and Mac, you can download a free tool called Anaconda. By a firm called Continuum Analytics, and it basically just gives you this sort of really easy interface to just get started with Python. So obviously that's a bit of a blank canvas, but it does mean you don't have to worry about any of the complicated installation. So once you've downloaded that and installed it, there are quite a few resources to go and learn Python programming. So I think if you're a complete beginner and you've never done any programming before, the best resources are some of these online MOOCs, massively open online courses. So there's Coursera and Udacity. I think Udemy. I can't remember. I think that's the name. And they all have a kind of introduction to Python course. Now, what that'll teach you is the sort of bare bones basics of how to actually program. So these will be things like sort of looping, so how to sort of do a procedure over and over again, how to make decisions within programming languages, so what they would call branching or if-else. So these are sort of basic programming concepts. So you'll learn all this kind of bread and butter programming skills, but also probably be building reasonably interesting projects. So I think once you've spent a few weeks, maybe a month or so, getting to grips with the basics, you'll be at a point where you can start experimenting with algo trading libraries. So now that some of them are very complicated, there's obviously a lot of complication in algo trading. So you could just get started by downloading some pricing data and then sort of trying to plot it and then running some very simple indicators over that. And I use a tool called Pandas, which is the Python data analysis library. It's also free. So all of this stuff, just to clarify, it's all free. Don't need to pay for any of it generally. It's all open source. And then once you've had a go with that, you'll get used to the interface, and you can start taking some of the ideas that you may have for algo trading and then applying them in Python. And thankfully, there's a good community of people who do this, and there's a great sort of quant blogosphere. I think if people should definitely check out a website called Quantocracy, which I'm sure you're pretty well aware of. It's a kind of link aggregator, if you like, for quant finance websites, and loads of the bloggers on there put a lot of tutorials out on how to use R and Python for doing quant trading. And there's loads of what they call snippets, little pieces of code that you can sort of just almost copy and paste, if you like, to have a go, and then step through line by line to see what's actually being done. And that gives you a good start, I think, into algo trading. And then you can just build up from there. It's really a never-ending road. I mean, I tend to think of myself as, still learning all the time. You're always a student, really, in quant finance. You're never a master, I think. Yeah.
Yeah, now that's really good advice. And I liked your comment about just sort of going through line by line and trying to work out what's going on here. I mean, I've been learning Python myself, previously a non-programmer, and I don't really quite feel comfortable calling myself a programmer yet. I don't really feel like I'm at that level, but definitely putting a lot of effort into learning Python. That's one of the things I found really helpful, was actually looking at, some reasonably basic algorithms that other people have written, which I might have pulled off Quantopian or something like that.
Yep.
And just going through each line and just commenting, using your hashtag at the start of the line, so it's a comment, so that that line is ignored, and just writing what actually happens on each and every line, like what's actually going on there. I found that really helpful. So no, that was a really good point.
Python's very good for that. I mean, it's one of the most readable, by design actually, it's one of the most readable programming languages. It's designed to sort of almost look, like how you would describe a recipe to somebody. There's very little hidden stuff going on a lot of the time, if that makes sense.
Yeah, it does. So here's a question. When you're coding a strategy, or when you're coding, I guess, anything at all, where or who do you turn to if you get stuck?
Right. Okay. So I tend to. So I. That's a tricky question. Right? So where do you tend? So I tend to have problems usually with sort of particular statistical algorithms, I guess. I presume you're talking about me, or are you talking about in general?
Well, yeah, I did say you, but I may be thinking that was not the right term. I may be thinking it would have been better if someone else, like if someone learning to program,
right,
let's take it that way.
All right, so yeah, if you by you mean somebody who needs help. So it depends generally on what sort of issue you're having. I mean, there are some great forums. So there's obviously Reddit, which has a lot of subreddits for quant finance and Python programming. I mean, it was started by the sort of computer sciencey kind of side of things. So there's loads of Python question and answer sort of sites. There's one of the best websites on the internet actually for any kind of programming or quant related question is something called Stack Overflow or Stack Exchange. So it's absolutely, you can generally find any question imaginable, somebody will have answered it. So usually what I tend to do, if I have an error or something's going wrong, I just copy and paste the error straight into Google, and usually Stack Overflow will be the first link that comes up. You look at it, and it'll be someone else who's had exactly the same error, and they'll say, what's going on here? And then there'll be usually a brilliant explanation beneath about what it is and how you can fix it. And I know that may sound a bit, unstructured, if you like, but that I can personally vouch for the fact that some of the top software developers use this method all the time. When they need help, they just Google the error message, and so that's one way of getting specific help for errors. But if you're having trouble coding a particular algorithm, some of the best places to ask, you can ask a question yourself at Stack Overflow, but more likely there's going to be somebody who will have done this. So let's say, for instance, I want to do a mean reversion cointegration tool or whatever. I've got some statistical test. I'll just type the name of the test into Google, followed by Python. And usually in the first 10 links, there will be some project or code snippet that allows me to sort of go, okay, I see how it works now. I understand. And so that is, that's generally my mechanism. But I guess a lot of this sort of behavior or intuition comes from when you do a sort of research degree in general. You're quite constantly doing this, so it becomes quite intuitive after a long time to kind of search for help in this manner when you're doing some kind of postgraduate course. So I think this is why a lot of quants tend to come from that kind of academic background in general, because they're quite used to sort of going and seeking help and looking at papers and figuring out how to take those papers and put them into code. So it's a good skill that I think anyone should really try and learn, even if they're not interested in academic study. I mean, it's a very, very good skill set for sort of retail quant traders, is to take papers and code from elsewhere and try and figure out what it's doing, if you like.
Absolutely. And I loved your suggestion of Stack Overflow too. I mean, I know that's got me out of trouble quite a number of times. It's such an awesome resource. Okay, Mike, well, let's start to wind this down. And there was one thing I wanted to just try to squeeze in, and, trading aside, I believe you're pretty big into space exploration. I mean, I'm keen to hear a little bit about this. Is it something that you're pursuing? Are you pursuing anything in this arena, or is it more of just an interest?
No, it's so when I said I did fluid dynamics at uni, it was actually in rocketry. So it's an area known as computational fluid dynamics, or CFD, and so you're trying to simulate. I was essentially trying to simulate a certain type of engine, like rocketry engines, and I've actually recently been thinking about, as a sort of secondary business to QuantStart, is to sort of get back into kind of analysis again. So CFD analysis for kind of different situations. So yeah, I'm mad keen on space exploration. I probably didn't talk about it as much on QuantStart, if ever, but I do make a bit of a noise about it on Twitter, certainly. But yeah, so I am actually possibly going to be working with a company that does is trying to do satellite design and launching in the UK. Unfortunately, I'm not allowed to say too much more about it at the moment, but it's looking relatively hopeful. And so I think I won't be directly involved on a day-to-day basis, but I'll probably have a sort of advisory capacity, because a lot of, like quantum finance, a lot of space exploration is really about testing. You're constantly trying to manage risk. In quant trading, if you launch a strategy and you lose a bit of money, it's painful and not, it's never fun, but you can yank the strategy out and turn it off. Whereas with rockets, if you launch it and something goes wrong, it blows up. At best, nobody dies. At worst, obviously, people can be killed. So you have to, the level of risk and mission criticality is absolutely, it's very different from other industries. But I think quant finance could probably learn a lot from space and the way they deal with risk. They won't launch anything until they're pretty much certain that it's not going to fail. And I think a lot of traders, myself included, actually could probably do with using more of that sort of risk management mentality, because I think it would reduce losses quite substantially.
Yeah. Well, that's awesome. You'll have to keep us posted on the details when you're allowed to share a little more.
Yeah, fantastic.
Anyway, Mike, do you want to share a little bit about QuantStart? Tell us, what is QuantStart for no one who's ever checked out the site before, and then we'll wind this down.
Okay, so I tend to think of it as an education portal, if you like, for quant finance in general. I mean, I have sort of gradually steered the ship over the last 3 years to talk a lot more about algo trading, but I still am very interested in talking about quant finance careers. So the site is, I would say, it's a mix of quant career advice and kind of quant trading advice, if you like, and tutorials. Now, my sort of key views, if you like, of a QuantStart is that I like to talk about the details that most people will not discuss, not because they're proprietary or secret, just because a lot of people think they're dull or boring. And I personally find that those aspects of quant finance are absolutely crucial for becoming profitable. All the stuff we talked about today, data cleansing, actually interacting with a broker via Python. How do you do it? How do you install these tools? There's not much really discussed about that. There's always discussion about trading strategies and what's the next best strategy that's going to make you your millions. And I personally find that a lot of the difficult stuff is actually quite dull to talk about, but it's necessary, and people have commented that they like that approach, so I sort of stick with it. The other aspect of it is I tend to try and share as much code as possible, so that people can just copy and paste it and use it themselves. I don't really like people saying, "Oh, I've done this, I've done that," without providing an actual bit of code. Because I've been trained as a scientist to think of reproducibility. That's what we're trained to do in the sciences. You want to share your work, and you want to make sure other people can implement it as well. It also helps to find bugs. People can write in and say, "Look, sorry, this is buggy. You need to fix it," and that just makes it better for everyone. So I think sharing code is a great idea. Also, probably the most important thing that I'm really keen on is to emphasize sort of continuous learning all the time. I mean, once we leave school or leave uni, most people, for whatever reason, just don't tend to want to continue learning as such. They think they've done school, they've finished uni, they got their grades, that's all good. But I think a quant's edge is really in their ability to continue reading all the time. I mean, if I had the ability, I would probably spend about 50 to 60% of my day just reading. And I know Warren Buffett is very famous for saying he spends 70% of his day just reading stuff. And I think that is probably the biggest source of edge in quant finance, is just reading and reading and reading, because you learn mistakes of other people, but you also learn about all these niche ideas that other people just aren't willing to find out about. And it gives you an edge naturally, because people just aren't willing to go that far, There's so many resources out there, not just the typical kind of flashy, trading ideas, but lots of white papers on hardware, really obscure things that you think, oh, hang on a minute, if I exploit this little trick here, I'd be able to, And so I think reading is absolutely important, and QuantStart talks a lot about that. So that's the basis of the site.
For sure. Well, I mean, anyone listening to this, I want you to check out quantstart.com if you have, even just the slightest interest in quantitative or algorithmic trading, which I'm going to probably presume you do if you've stuck through right to the end of this. So yeah, quantstart.com. And Mike, do you want to give out your Twitter handle as well?
Yeah, so my Twitter handle is mhallsmore, so MHALLSMOORE. So I did have originally a QuantStart Twitter, but I tend to now do it all through my personal account now. So that's my Twitter handle. Good one.
Okay. All right, Michael. Well, I've been looking forward to this interview for such a long time, so I'm glad we could make it happen. Thanks so much for doing this, man. I really do appreciate it.
Yeah, thanks for having me on. It's been absolutely brilliant. Thanks for taking the time to ring at 8 a.m, UK time.
No trouble. Thank you.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.